Welcome back to Growth Without Referrals. Today I'm joined by Chris Moore from Fortuna Advisors. Chris has built his career at the intersection of corporate finance, strategy, and value creation with leadership experience across organizations like UPS, SunTrust, and Raytheon, and now working with companies to think differently about capital allocation and long-term performance. Chris, welcome. Glad to have you here.
Thanks, Mark. Happy to be here.
So, Chris, let's start with your story. You have a diverse path, including time serving as a U.S. Navy officer and then moving into corporate finance and strategy roles across multiple industries. Walk me through that transition. What drew you into finance and strategy after your military experience?
I entered the Navy after college, went through officer candidate school with the ultimate goal of a career in the intelligence community. At the time, I was interested in working for either the FBI or the CIA. So I spent 3.5 years in aviation, a couple of years before that in training. And then after my tour in the aviation, I started working as an analyst at the Office of Naval Intelligence. So kind of set myself up pretty well for that, transition into that after my time in active duty. But along the way, I developed other interests. So specifically, started kind of managing my own money, learning a little bit about corporate finance and investing, and decided that, that was sort of the route that I wanted to go. About midway through my time in the Navy, I enjoyed my time very much. It's a tremendous honor to serve in the military. And a lot of the skills that I developed today were really what I did in the Navy was the foundation of that. So, and to this day, one of the funnest jobs I've ever had was working directly with the intel community for 3 years. But after the Navy, I got my MBA at University of North Carolina in Chapel Hill, and then spent some time at Raytheon. Started off in a executive development program. It was a rotational finance program. Rotating across different business units, different disciplines within the finance function. And then for personal reasons, I had to relocate to Atlanta. So after about 4.5 years at Raytheon, I spent some time at SunTrust Banks, which is now recently merged with BB&T a few years ago to form Truist, the fifth largest bank in the country. And that position was a sort of a mix of a FP&A type position and a technology PMO. So we were sort of the gatekeepers for the strategic investment portfolio for new projects within the bank. And we also performed a lot of the financial analysis around the performance of that portfolio. Spent some time there. I liked the team I was working with. I liked learning a lot about the technology. Wasn't necessarily in love with banking for the long term, and found myself with an opportunity to work in the FP&A team at UPS. And that was where I met the partners that I'm currently working with now at Fortuna Advisors.
Excellent. And Chris, what did your military experience teach you about discipline or decision-making that still shows up in your work today?
I think the biggest thing is a sense of ownership. I think one aspect about the military that people who are proactive benefit from is the path to success is transparent. There are very objective measures to achieve in order to do well at your job and in order to get promotions. By no means easy. I mean, earning your wings in flight school was equally as hard, if not harder, than my undergraduate work. I had to learn a lot of engineering concepts, and that was a huge adjustment coming from a liberal arts background. I was a political science major in college and undergrad, and no one's there to hold your hand to help you transition to it. So you've got to do all that on your own. And then when I transitioned from active duty to the intel community, the intel community consists of 16 agencies and 100,000 employees, if not more. So that was all about relationship building and being accurate with your reporting and building a good reputation and creating demand for the work that you do. And I think some of the best career advice I ever got was from one of my bosses when I was working at the Office of Naval Intelligence. I was about 10 months into my assignment there, and we were having a one-on-one, and he said, Chris, you've done well here. You know, this is certainly a good fit for you, and you've progressed past the point where I can QA any of your work. So the only advice I can give you is don't screw up, because people trust you, and the second you screw up, you're going to lose that trust. So, and I think those were kind of the two big things that stuck with me from the military, is adopting a strong discipline around self-improvement and self-learning, and taking ownership for your actions, and building relationships.
That's great. And Chris, I do want to say thank you for your service. That's
Certainly,
excellent.
it's an honor.
One thing that stood out when we spoke earlier was your observation that many consulting firms, including yours, rely heavily on referrals and relationships. And that approach is powerful, but it comes with trade-offs. Let's talk about that. How has referral-driven growth worked for your firm? And where does it begin to create limitations?
Well, it works because we are a small company, but our partners are very well connected. They've had success with the clients that they've been working for over the 20 years that the firm's been in existence, almost 20 years, and that success compounds upon itself. So CFOs don't stay in the same companies for long. They move to other companies, and if they think our framework is going to work there, a lot of times we get repeat calls from the same CFO who's gone to multiple companies, and those CFOs are also on boards of other companies, so they've referred us to the leadership at the companies for the boards that they sit on. It has been a stable source of business, and going back to the relationship building, there's anytime we see a prior client, and it doesn't have to be a CFO. A lot of times the VPs of finance get promoted to new positions, so we get referrals from all levels of past clients. But there's a much lower theoretical ceiling on that type of business than the theoretical ceiling for a product company that has a strong brand.
Okay. Chris, your work at Fortuna Advisors focuses heavily on value creation and capital allocation. That is interesting because growth decisions are ultimately investment decisions. How do you think about growth through the lens of capital allocation?
Well, we refer to ourselves at Fortuna Advisors as a shareholder advisory firm. So we help companies implement a concept called economic profit. And our specific version of economic profit, we call it residual cash earnings. But essentially, it's the income that a company generates beyond what investors expect them to generate based off what that company has invested in itself. So I'll do a real quick example. If a company spends $10 million on to build a new factory, and their required return is 10%, investors are going to expect them to make $1 million a year from that factory. If they make more than $1 million, then their economic profit, or their residual cash earnings, is their earnings minus that $1 million. So if they're making more than $1 million, they're creating value. And if they make less than $1 million, then they're destroying values. Investors are going to believe that their money is better off elsewhere, and they may start selling the stock. They may start pressuring the company's leadership to divest underperforming assets and reprioritize their investment portfolio and their strategic project portfolio. The catalyst for this is there's a big disconnect between what investors are looking for and the common financial measures with GAAP reporting and standard accounting reporting. We'll look at two common measures: operating profit or EBITDA. Those are the two most common earnings components that we see in incentive compensation structures. They're incomplete. There are many ways to grow EBITDA. Not all of them are good. A sales team can give more lenient payment terms to a client, so they can go from paying in 30 days after delivery to paying in 90 days after delivery. That's going to increase sales. It's going to increase EBITDA, but it's also going to increase the amount of capital that's tied up in the business. So then with an incomplete measure, there's a whole other exercise you have to do to see if the incremental EBITDA you get from that decision is overcoming the cost of capital. The other common way that companies can destroy value while growing EBITDA at the same time is by overpaying for an acquisition.
Mm.
So our measure is, we feel it's better than most of the common gap-based measures that you see out there for several reasons. First is that it's comprehensive. So it balances growth, it balances profitability, and it balances capital productivity. You can't say that about revenue. You can't say that about EBITDA or operating profit or even free cash flow or ROIC. Second is that it sends a consistent signal. Up is good, down is bad. Again, yeah, I went through the example with how increasing EBITDA is not always a good thing. Same goes for return on invested capital. A lot of times companies have a high return on invested capital because they haven't invested in a long time in their company, and a lot of their assets are nearing fully depreciated. So they're dividing what is a static level of operating income by a denominator that's decreasing at a faster rate than their operating income is increasing. That creates the illusion of value creation when there is none. The third attribute is, we've done a lot of capital markets research on residual cash earnings, and it has a very strong relationship with total shareholder return. So, companies that grow residual cash earnings on a regular basis, they can feel confident that the share price is going to follow. And one of the best examples that we have from this is Amazon in the early 2000s all the way through 2020, in the early 2020s. Traditional measures of valuation didn't come close to Amazon's market cap. And the reason for that is because they invested heavily in R&D. In some cases, in the early days, investing more than 100% of their earnings and sometimes their free cash flow in R&D and CapEx. And if you added that back, so last year, Amazon invested over $100 billion. It's $100 billion in R&D. That's large enough to be a Fortune 100 company by itself. And so, just that's one of the reasons that our measure has a much stronger relationship, because that's one of the adjustments we make to residual cash earnings. We add R&D back to the earnings component, but we also capitalize it and include it in the capital charge. So, companies can feel confident that if they grow RCE, then their share price will follow. Our valuation method using RCE tracked Amazon's share price within 10% each year from 2020 till about 2023. So when no other measure came within 65 or 70%. And then the last is that it's universal. This measure means the same thing to companies that require a lot of assets as it does to companies that are very asset intensive. So by multiplying the invested capital, or what we call gross operating assets, by a required return, we effectively convert that to an expense, and it puts all the companies on a level playing field. And this is specifically important today when you have companies with multiple business units. Some require very little capital, some require a lot of capital, and EBITDA doesn't tell the same story for those businesses. But when you apply capital and residual cash earnings to it, then you get an apples to apples comparison for all those different businesses.
Okay. Chris, looking back across your career, working in different industries and leadership environments, what mistakes do organizations repeat when trying to scale?
I think a big one is not having an appreciation for the end-to-end implications of any strategic initiatives. So a lot of big changes oftentimes come from the outside, or they come from a corporate strategy team that is staffed not from people who work their way up the company, but from people who came from the outside, either from investment banks or from Big Four consulting firms. And I think that one of the biggest things that I've noticed is just a very lack of appreciation for the end-to-end implications of their recommendations. Many things sound great when they're talking at the very high levels of the company, but when it gets down to actually making it work with people who are implementing things on a day-to-day basis, then they don't have the appetite to work out those fine details. So I think that's one of the first things. Second is the very incentive compensation that isn't well designed. If you look at the proxy statement for any public company today, you're typically going to see a top line component that they use to attribute or use to determine their target payout, and a earnings component. So usually, so there'll be a revenue growth target. There's going to be an operating profit or an EBITDA target. And then there's usually, a handful of operational or ESG components that are in there as well. So when they set those targets, first of all, the way they set those targets is, the corporate leadership has an idea of what kind of growth they think the company can achieve, and the business units have a idea of what they know they can achieve. Those two targets or those two assumptions are very far apart at the beginning. So what it does is it incentivizes the business unit leaders to sort of sandbag their target. They want a target that they know they can achieve, so they get their bonus, and so they meet somewhere in the middle. So that is what you end up getting is they plan for 2% growth and they get 5% growth. We would rather see companies plan for 10% growth and get 8% growth or 9% growth. We want to remove that incentive to sandbag the plans for a given year. But going back to our framework and our measure, since the residual cash earnings sends a consistent signal, up is good, down is bad, then it makes the target setting process much easier. So the target is the RCE that was achieved in the prior year. So if they hit that, then they get their bonus. If they beat it, they get more than their bonus. If they don't beat it, then they get less than their target. So that's one of the first things. And I think one of our partners, we had a client suggest to him that we didn't think planning was important. And he said, no, that's not the case at all. We think plans are so important that they shouldn't be corrupted by bad incentive structures. And so that's one of the other mistakes. And this is sort of a corollary to that, but when you have a top line component and a bottom line component in the incentive structures, it incentivizes some additional strange behaviors. At one of the companies I was working at, I won't mention which one, but there was a customer that had a large material order that they were chasing for several weeks, and it was about a $10 million material order, but the markup on that material was 0.1%. So they were spending all their time chasing this material order so that they could hit their sales target at the end of the year, but the profit was less than a fraction of what they would have gotten from incremental sales on one of their services projects or components that had a 20% operating margin. Their incentive structure incentivized them to chase what was effectively $100,000 in profit on $10 million in sales.
Chris, a great perspective. And when companies talk about growth, the conversation often focuses on revenue, but growth also creates operational pressure. From your perspective, what tends to break first when companies grow too fast? For example, is it leadership bandwidth, systems, talent, decision-making?
I would say it's probably leadership bandwidth and attention capacity is the first thing that breaks. So, or one of the behaviors we help to try to get companies to seek is extreme prioritization. And that's identifying the projects, the products, the customers that are achieving, creating the most value. The Pareto principle applies here. The 80-20 rule. A lot of times, in most cases, 80% of your value is going to come from 20% of your portfolio. So, when the portfolio gets too big, they lose sight of where, that value is really being created. And then I think a lot of companies, they outgrow their ability to communicate cross-functionally is one of the big things. And it was such a huge factor that when I was working at UPS, the process that we had to get projects approved, it wasn't just completing a DCF and a sensitivity analysis on the earnings. It was talking to operations, and there were several stage gates that they had to go through. So if marketing had a new idea for a product or an offering, they couldn't just go to the board and ask for it to be approved. They had to go talk to domestic operations. They had to talk to international operations, and they would have to say, do you have the capacity to meet the demand that we can create from this product. And they would have to get their blessing before they could go to the board to get that approved. And when I discuss that with people at my company, a lot of the junior folks, they felt that it was a huge administrative burden, and it wasn't. It was absolutely necessary in order to make sure that they were building a product portfolio that they could actually service, and that they weren't inadvertently cannibalizing existing profitable products.
Okay. Chris, looking ahead over the next 12 to 24 months, what do you think leaders should be paying attention to right now, and what trends are shaping how companies grow?
So having a strong understanding and ability to create the value proposition is the biggest one. You've seen so much turmoil in the investment space, mainly coming from AI. There are many. Software has been hardest hit. The investor world believes that every B2B software company is going to be made obsolete by AI, and these companies are still making plenty of money. They're still they're still growing. Those companies aren't being evaluated, or they're not getting valued on their past performance right now. They're getting valued on their expected future performance. And the companies that have a true sense of their value proposition and an ability to integrate these new concepts into their offerings are the ones that are going to come out on top and survive this. And I think the other thing to watch out for is there's been a big rise in activist investors over the last several years, that has specifically been a big attribution, or a big cause of that has been a change in SEC rules that make it easier to target specific positions on a company's board rather than seeking a clean sweep of the board, which is what the traditional activist approach was. And so you're seeing a lot of activist involvement. And the way that companies are trying to prepare themselves for that is by moving to a complete measure of value creation. They're moving away from valuing their performance on EPS or EBIT growth, and they're looking at the return on capital as well. And I think that is how to best prepare yourself from an assault like that, is understanding whether or not you're actually creating value in the eyes of investors. And in order to do that, you need a complete measure and a way to communicate that.
Chris, this has been a great discussion, and I appreciate you sharing your perspective. Before we wrap, for listeners who want to learn more about you and your work at Fortuna Advisors, what's the best way for them to connect with you?
Well, we just released our annual buyback ROI report. If they run a search for that, Fortuna Advisors buyback ROI report, that'll take you to our website. We've published over 300 articles since we've been in business. We've been published in Journal of Applied Corporate Finance, Forbes, CFO.com. Our website is fortuna-advisors.com, so we can be reached there. And we're also very active on LinkedIn. So those are the best ways to reach out to us.
Excellent. And for our listeners, I will be putting Chris's contact information in the description of the podcast. Chris, thank you again for your time and insights.
All right. Thank you, Mark.